Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Surprise, surprise, surprise. We have a positive article in a mainstream publication on reverse mortgages. Thanks for joining me today on Reverse Mortgage Radio. You heard me correctly. Yes, we do have a positive article in a major publication, Money Magazine. Now, there have been some positive publications about reverse mortgages, but a lot of them contain inaccurate information too. This article is 99.9. I'm going to point out one little thing, but overall it's accurate and it's a well-written article in Money Magazine. It's dated March 28th, and it's written by Lindsay Van Summeren and edited by Jordan Chusler. And it's called 5 Common Reverse Mortgage Myths Debunked. They do a great job in this explaining about myths about reverse mortgages. So many times I tell people, it's just out in the ether that reverse mortgages are bad, right? Everybody knows it. Well, they shouldn't know it, to put it bluntly. They shouldn't, because the problem is people think they understand how reverse mortgages work, and most people do not. If you've listened to this show for any length of time, I'm sure you've heard me talk about these in different orders or these myths in separate shows. Every now and again, I'll put together an episode about common misconceptions or things of that nature. But this is a very well-written article, and I'm going to read most of it from you and add my color commentary as well. In case you didn't realize it, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage in Denver, and I've been specializing exclusively in reverse mortgages since January of 2003. Now, back then, when we first started, there was zero positive press about reverse mortgages. Now, over the years, all these different years, especially from probably 2009 to 2019, there were a ton. Every year there was changes about reverse mortgages instituted by HUD. And we as an industry had to follow and adopt these changes. And if we didn't, obviously we couldn't close loans because we weren't following their rules. So we have to follow all of HUD's rules. And there were a lot of changes that were, let's just say, painful. And it still is kind of painful because one of the big changes over the years that they made numerous times was cutting the amount of money they allow us to loan to people as a percentage of the value of the home. We used to loan routinely 50, 60, 70% of the value of the home. Now, it's a good thing, honestly, that we're no longer loaning 70%, unless you're 99 years old. But it still hurts when somebody contacts me and says, hey, I've got $400,000 in equity. I'm 62 years old. Can I get a reverse mortgage? And I ask them some details. They say, well, my home's worth $800,000. I owe $400 on it. So they're 50% loan to value. They owe 50% of the value of the home. And I say, unfortunately, I cannot help you because you do not have enough equity. Because for people that are in their early 60s, we're loaning 32, 33, 34% of the value. That's all we can loan. And I'm saying that now, not to get you not to call me, trying to set expectations about reverse mortgages. Because sometimes, well, a lot of times actually, when people call me, they think that they can get 60, 70, or even 80% of the value of the home. And that's just not the case. They think, okay, well, I'll pay off the mortgage and then I'll get all this extra money to pay off some other bills or have money set aside for a line of credit that we talked about in the last show. That's so beneficial. It's incredibly beneficial. But that I just like to try to set expectations for people. Feel free to call me. I'd love to talk to you, because just because you might not qualify now doesn't mean you won't later. If interest rates fall, values increase, plus the fact that you get older. The older you are, the more money you can receive from a reverse mortgage. And actually, before we get too deep into this article, or before I even started at all, I want to explain what a reverse mortgage is in case this is the first time you've ever heard this show. A reverse mortgage, most of the time, is an FHA insured loan. Now, FHA falls under the umbrella of HUD. And sometimes I use the two terms interchangeably. They're really not. But basically, it's about the government setting rules because they insure the loan. That means that if the lender ever goes out of business, FHA will take over the loan, or HUD will take it over, and they'll find a company to service the loan on your behalf for you. Also, too, they provide insurance to the lender. That's one of the things that we talk about in reverse mortgage a lot, is the upfront cost. And they address that in the article, because all FHA insured loans have mortgage insurance. And the mortgage insurance actually protects the lender. It's kind of weird, but yes, the lender's protected. Since the lender's protected, that indirectly protects you, your estate, and your heirs. The reason for that is the way a reverse mortgage is structured. As long as you live in the home, pay your property taxes, pay your homeowner's insurance, you maintain the home, and you keep your name on title, you can never, ever, ever owe more on the house. Well, actually, you're never responsible for anything beyond the value of the home. Because what happens is no monthly payment is required with a reverse mortgage. You can make payments on it, but as long as you live in the home and follow those rules, you're not required to make a monthly payment. That's the beauty of this loan. That's why most people get the reverse mortgage, is because it relieves that burden of a monthly obligation. People say, oh, reverse mortgages are risky. Well, what's more risky? Having a mortgage that if you miss one or two mortgage payments, they can foreclose on you, or having a mortgage that requires no monthly mortgage payments as long as you continue to pay your taxes and insurance and live there, along with the other rules. So that's how a reverse mortgage is insured. You're protected in that respect. So what happens is that interest that you're not having to pay out of your pocket has to go somewhere. It gets added to the loan balance. If you borrow $100,000 today on a reverse mortgage, 10 years from now, you might owe $170,000 or $180,000 or $200,000, depending on whatever the interest rate is. Now, odds are, if you have a house worth $400,000, over the same 10 years, that $400,000 house might be worth $600,000 or $700,000. The difference between the value of the home and the loan balance, whether it's a conventional mortgage or a reverse mortgage, but the difference is your equity. You take the $400,000 value minus $100,000 loan balance, and you have $300,000 in equity. And odds are the value of the home is going to appreciate at a faster pace than the interest will accrue on the loan balance you owe, at least at the beginning of the loan. Over time, they kind of catch up with each other. And it's possible that you could eventually end up owing more on the house than it's worth. You might owe it, but you're not responsible to pay for it. In that scenario, you pass away, let's say your heirs inherit the home, and they see that you owe more on the house than it's worth. They have options, and they address this in the article too, and that we'll get into. But they can sell the house, or actually they don't even have to sell it. They can sign the house over to the lender and walk away. The lender will then sell the house for whatever they can get for it, and the difference, the amount of money they would normally lose, they file a claim with the mortgage insurance company so that the mortgage insurance pays the lender. And you say, well, why do I have to pay for that? Because that indirectly protects you. That allows them to loan more money, and also it allows them not to, or it doesn't allow them to come back to you to collect any money they lost, because they didn't lose any money. The mortgage insurance paid it. That if they lost money, they could sue you and your estate and collect what's called a deficiency judgment against you. and they could try to collect that money from your estate. If you left $100,000 in a bank account to your heirs when you pass away, and the bank lost $100,000 on the reverse mortgage, they could come after that and collect that money, and you wouldn't leave your heirs anything. With a reverse mortgage, with the mortgage insurance portion of the reverse mortgage, that cannot happen. So you're protecting your estate and your heirs and yourself. If you have to move to assisted living and you don't want to be owing money to a mortgage or to the bank for anything. That's a quick summary, basically, of how reverse mortgages work in a nutshell. Let's talk about this article. The article starts off, it says, many Americans are retiring with less cash than they would like, but in some instances, this can be offset by unexpectedly large yet welcome boosts in their home values. Financial planners frequently recommend reverse mortgages. Now that line in itself, I've never seen printed anywhere, because that did not used to be the case. That it used to be the opposite. Reverse mortgages were a pariah of financial advisors. They would either say, don't do it, don't ever do it, I would never, ever, ever recommend that, or they would say, I cannot tell you anything about it, because companies, financial advisory companies, actually restricted their planners from talking about reverse mortgages at all. But now, in this article anyway, they say financial planners frequently recommend reverse mortgages to help qualified older folks supplement their income in retirement. But misconceptions are commonplace. And then they have, here it says, it's not a tool for everything, says Zachary Barton, certified financial planner and founder of Barton Financial Group. This is one area that irritates me. It's not incorrect, obviously. I mean, reverse mortgage is not for everybody. But why do you feel you need to qualify it by saying that? You could say that about home ownership or a regular mortgage or owning a car or anything you could say that about. And it just is a little pet peeve of mine that people feel the need to qualify that. But then Zachary Barton goes on to say, if you use it appropriately, it's a great tool. Well, the same goes for any mortgage. All right, get that out from under my skin there. Industry experts and knowledgeable homeowners often concur. In a 2024 opinion survey, 62% of older homeowners agreed that reverse mortgages offer more financial freedom in retirement, provided that they knew how they worked. In other words, the implication is they don't know how it works. And in the article, and I'm going to link to this article on my website. If you want to go to my website at reversemortgageradio.net, you can find this podcast, and underneath in the description part, I'm going to link to this article because it's a really good article. And in there, they've got a link on, if you click on Knew How They Worked in that article, it'll take you to another article that Money Magazine offers that talks about how reverse mortgages work. And that's a pretty informative article too. But then the article continues. Here are some of the misconceptions about reverse mortgages, including how they arose and how you can separate fact from fiction. Number one myth, reverse mortgages are shady. I've heard, reverse mortgages are bad, all different things. But the article continues. Over the years, financial regulators have introduced many consumer protections when it comes to reverse mortgages, particularly for the home equity conversion mortgage, which are the most common kind. That's the FHA-insured kind. That's the name of the FHA-insured reverse mortgage program, Home Equity Conversion Mortgage, or HECM, HECM. And the article continues now. For example, there is now a pathway for spouses to stay in the home if they are not listed on the loan, and lenders must take extra steps up front to limit borrowers from running into trouble down the road. And I've talked about the non-borrowing spouse thing. It used to be that some loan officers would advise people, or people would want to take a younger spouse off the title of the house and get a reverse mortgage in their own name because the older person can get more money. Say somebody's 75 and they're married to a 62-year-old. They remove we base the loan amount on the younger of the two homeowners. So if we take the 62-year-old off title, then we could qualify the person for more money because the person that's 75 would qualify for more money because they're older. The reason that is the older you are, the more money you qualify for, because you're going to keep the loan a shorter time period, which allows for less time for interest to accrue on the loan balance. But what would happen is that older homeowner then passes away 2 years later, and the loan is called due because the spouse is not part of the loan. Now we protect non-borrowing spouses. So if a spouse is not on the loan directly, we still base the loan amount on the spouse's younger age, whether they're on the loan or not. So that allows them to stay in the home. Even though they don't have access to any additional money from the reverse mortgage, they can continue to stay there. Okay. And then they go down here. Today's reverse mortgages are a far cry from the late night infomercials of the 90s, but that reputation has not been easily shaken. Everyone seems to have a general uneasiness, Barton says. I don't feel like the product was bad. They were just missold. And I think that's one of the best statements in this article. I don't feel like the product was bad. It was never a bad product. It's really not that different from when it started, honestly, other than the fact that we're loaning less money and now we have to qualify people for with income and credit. We didn't used to have to do that when I first started. And in 2014, we began qualifying people. So you have to show that you pay your bills on time and that you can afford to pay your taxes and insurance if you get a reverse mortgage. That was really a good change to the loan. Okay. Myth number 2, reverse mortgages are a last resort. And I think this is the most damaging myth that people have about it. They think that only desperate people get reverse mortgages and it's last resort. You've run out of all your other options. Well, that's not the case. And they talk about it here. He says, if reverse mortgages cannot be trusted according to common sentiment, then the only people who use them must be out of all other options. However, these secured loans can provide much needed cash flow for people who do not have other assets to draw on in retirement. But generally, it's better to use reverse mortgages as a way to diversify overall retirement portfolios, similar to how you would diversify your investment portfolio. In fact, when set up properly, they can be a boon to retirees who have a perfectly adequate savings. It is possible to set up a reverse mortgage to provide steady monthly payments that cover fixed expenses like your property taxes and insurance for as long as you live, offering an extra layer of security you otherwise would not get with invested savings. You can also set up a reverse mortgage as a revolving line of credit. Check out my podcast from last week that you can draw on as needed. For instance, when a market downturn results in investment losses. Doing so can reduce the likelihood of having to sell those stocks in your portfolio when it's down, according to Barton. And when you do that, he says, you can actually reduce how much you need to have in retirement. But the biggest testament comes from a 2016 study by the Financial Planning Association that looked at how different retirement portfolio options would play out over time. The simulation showed that homeowners taking out a reverse mortgage line of credit at the start of their retirement doubled their odds of success, in other words, not running out of money, over the course of a 30-year retirement. Without a reverse mortgage, the model portfolio stood at 40% chance of having enough cash to last over 3 decades in retirement. However, with a reverse mortgage, those odds doubled to 80%. That's a pretty good return for your investment there. Okay, so that's number 2. Number 3, myth number 3, reverse mortgages are expensive. This is an issue Barton says he comes across often, and so do I. Adding to the caveat that expensive is relative. Reverse mortgages do have upfront costs, not unlike mortgaging a property, that can add up to several $1,000s. But with a reverse mortgage, you can roll those costs into the loan amount. But unlike a traditional mortgage, borrowers are not required to make recurring payments. That is the main reason borrowers choose a reverse mortgage, after all. Instead, the loan balance ticks upward in the background with interest and fees being added each month. The balance isn't settled until after you're out of the home, but you or your estate will never owe more than your home is actually worth, no matter how large the balance grows. And this is me talking again. For some reason, they put here but your estate generally will never owe more than the home is actually worth. That should say never will owe more because of that mortgage insurance. Mortgage insurance is a cost to the loan. That's why people say reverse mortgages are expensive, because the mortgage insurance that is paid to FHA is expensive as compared to a conventional loan. But this reverse mortgage really you really shouldn't try to compare it to a conventional loan. It just doesn't work that way. It's not like a conventional loan. So anyways, that's my little pet peeve here. The one little thing that they didn't do the way that they, as clear as possible in this article. That's the only downfall of the article. By the way, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. You can reach me directly if you have any questions about reverse mortgages at 303-467-7821. That's my direct line, 303-467-7821. You can also visit me online at reversemortgageradio.net. And we're talking about an article that just was published on March 28th in Money Magazine called 5 Common Reverse Mortgage Myths Debunked. And we're talking about all the different myths that people have about reverse mortgages. And I'm going to include a link on my podcast on my website at reversemortgageradio.net. So go there, check it out. While you're there, download my consumer guide about reverse mortgages. It's a reverse mortgage consumer guide. And then also you can even get a quote right then and there. Then you'll see the numbers, how much you qualify for on my website as well, too. No cost, none of that's cost. So the first 3 misconceptions we talked about were that reverse mortgages are shady, and that's not true. We know that. Reverse mortgages are a last resort. That should not be the case. It is sometimes, but it doesn't have to be. And reverse mortgages are expensive. Now we're going to talk about number 4, which is your heirs will not inherit your home. And that's just flat out not the case. Your heirs will always inherit your home. Sometimes you might owe more on the house than it's worth, but they still inherit it, and they have options. We're going to talk about that now in the article. That's one thing I really like about the article, too, is they address that. Okay, another common misconception about reverse mortgages is that your heirs won't be able to inherit your home after you are gone. But there is nothing in reverse mortgage loan documents that excludes the heirs. In fact, they may even get certain benefits in keeping the home. When the time occurs, your heirs decide what to do with your home. Sell it, turn it over to the lender, or pay off the reverse mortgage to keep it, usually by getting a new mortgage of their own. If the reverse mortgage balance grows larger than your home is actually worth, as is possible, then your heirs only have to repay 95% of its current value to sell it or keep it. So in other words, they might get a 5% discount on your home. So basically what they're saying there, normally what happens is they sell the home. When you pass away, they inherit the home. They sell it. Let's say they sell it for $600,000. You owe $200,000 on the reverse mortgage. They pay off the reverse mortgage and they inherit the $400,000 in equity. However, if you're upside down on the home, then they have an option of, if they want to keep the house, they only have to pay 95% of whatever the value of the home is. So now the value is dropped and the loan balance continued to rise. Now you owe, when you pass away, the balance on the loan is $500,000, but the value is only $400,000. Your heirs can go get a new loan for 95% of $400,000, the actual value, and the lender has to accept that 95% value as a payoff, and then they'll release all liens on the home. Okay? That's important. So it says here, importantly, heirs are not required to sell the home to satisfy the loan balance. They have the option of repayment with cash or by taking a new mortgage. And then they quote the financial advisor Barton again. He says, I do think people worry about that too much. Most of the time, people's adult children don't want to move into the house that their 85-year-old parents were living in. They're going to sell it, he says. So then, what's the difference between selling the house that has a reverse mortgage on it versus a traditional mortgage that's just not paid off? Well, one benefit of having a reverse mortgage as compared to a forward mortgage is no payments are required. You still have to make that mortgage payment if you inherit it. Now, you do have to sell the home a little quicker sometimes, but either way, it's a good program. The fifth and last myth is you won't own the home anymore. Another common misconception is that reverse mortgage borrowers no longer own the home. As is the case with a normal mortgage, you are the legal owner of the home, title and all. But when you have a mortgage, forward or reverse, your lender also has a lien on that home. That allows them to foreclose on your home if you don't meet the terms of your contract. With a reverse mortgage, the terms of the contract include, like we talked about, living in the home as your primary residence, staying current with home repairs, and keeping current on your taxes and insurance. So and then they wrap up the article here by saying, if you have a reverse mortgage, it should decrease the chance that you cannot pay your taxes, Barton says. In that regard, a reverse mortgage can actually help you stay in your home for a longer, not a shorter amount of time. And that's why I like this article, is that they really make a case for reverse mortgages. So let's just review real quick. The first myth that they talk about, that I'm sure you've heard me talk about over the years, is reverse mortgages are shady. Not the case. Reverse mortgages are a last resort. Definitely not the case. It could be the case for you. Maybe it is your last resort. But if you choose to do a reverse mortgage before you run out of all other options, it's still a great program. That's what I plan to do, because I'm going to get a reverse mortgage when I'm age allowed and when I move into a home that I'm going to stay in. Because right now I'm in a home that's multi-level and we back up to a busy street. I'm not going to retire in this home. I know that. But before I retire, I'm going to buy a home, probably somewhere up in northern Colorado. We'll see. And I'm going to use a reverse mortgage for purchase to do that. And I'm going to actually overfund it. And that's something I should do a whole show on that, the benefits of overfunding your reverse mortgage for purchase. So if you're looking to buy a home and you've got $600,000, but you can put all $600,000 down and get a smaller reverse mortgage, or you could put $500,000 down and get a bigger reverse mortgage, it might benefit you to put all the money down and keep money in a line of credit. And that's a whole nother topic for another show. But let's continue on. So myth number 4, your heirs will not inherit the home. We know that's not the case. And number 5, you won't own the home anymore. It's always funny because back when I first started, I got a call from somebody who called me and said, hey, if I get a reverse mortgage, who do I call if I get like a leaky faucet or something? I just said, not me. But basically, he was under that impression that he didn't own the house anymore. You're selling the house to the bank, and that's not the case. If you have any questions about what we talked about today or anything about reverse mortgages, please call me. I'd love to talk to you, and I can talk to you about your specific situation and run numbers for your specific issue that you have, whatever you're trying to accomplish with a reverse mortgage. It may make sense, it may not, but you don't know unless you find out the details. You can reach me directly at 303-467-7821. 303-467-7821 is my direct line, and you can also visit me online at reversemortgageradio.net. Like I said, I'm going to have a link to this article there. You can go there and check it out. It's very informative. And then there's another link about how reverse mortgages work and things that you can go there as well. You can also find all that information on my website at reversemortgageradio.net. Hope you have a fantastic day, and thank you for joining me.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.